Hi, and welcome to our weekly roundup of the major news stories so far. Now, last week, obviously, we spoke quite a lot in each video about the figures and the data that was coming up and sort of the impacts that may well have. And you're going to see a common theme today that, the data came out and it certainly had some impact. So we're going to start off with looking at the S&P 500, and that's hitting some new highs yet again. What happened to the US dollar off the back of some of the major economic news that's been out this week. Thirdly, we'll take a look at the FTSE 100, the UK 100 with us. Not fared quite as well as the S&P 500, shall we say. And we'll finish off with gold and see that is also being affected by some fundamentals. So, we'll start with the S&P 500. Wednesday this week, we saw the US CPI, or inflation figures, released. What did we get? Well, year on year, CPI was 3.3%. That was against a forecast of 3.4% and a previous figure of 3.4%, so slightly better than expected. Month on month, CPI was 0% flat. We're expecting it to go up 0.1%, and previously it went up 0.3%. Now, core month-on-month CPI, that's excluding food and energy, that came in at 0.2%, a forecast of 0.3%, and a previous of 0.3%. So the indications are that inflation is slowing down again in the States. Maybe not very quickly, but it does seem to be happening. And thus it boosted expectations of easing of monetary policy by the Fed. So consequently, the dollar weakened, which we'll come on to in a moment, but stock markets surged. The US SPX Mini 500 with us at FXOpen passed 5,444 points, rising approximately 1.1% within 2 hours of that news coming out. Later on, once we had the actual Fed decision, which unsurprisingly was unchanged, I think everybody expected that, and importantly, a press conference by Jerome Powell, where he spoke about the possible rate cut before the end of the year. And in fact, some analysts were saying that he even hinted at maybe 2 cuts, as the FOMC average came in at about 1.5 cuts for this year. Now that is down obviously on the 3 we were expecting earlier this year. So let's take a look at the chart and see what that shows. Well, the market is moving in the ascending channel, which you can see in blue. Now before the news, the price was near that medium line, but rose towards the upper boundary in the evening. And importantly, the price passed through the psychological level of 5,400 and the RSI entered overbought territory. So again, that's a slight imbalance that we see sometimes with a sudden upward move. Will this rally continue? Well, as the chart shows, the decline B to point C is less than 50% of the rise A to B. And that can be interpreted as a normal correction during an uptrend. Now, the sustainability of that uptrend will depend upon the S&P staying above the 5,400 level. That's going to be quite key. After that, the 5,300 level could also become rather important if we do see a slide. That acted as support from the 16th to the 22nd of May this year, but converted into resistance around the 3rd, 4th of June. Further support could come from the median line, and of course, if we get any more dovish news statements coming out with regards to potential easing of monetary policy by the Fed. But I think it's, as usual, going to be quite choppy with a little bit of volatility, so don't forget your risk management techniques. Okay, we've seen that data that came out gave the stock markets a bit of a fillip, but what happened to the dollar? In fact, that was down after that inflation data. Second consecutive decline in US core inflation showed us quite a sharp drop for the dollar. Cable, that's the Great British Pound against the US dollar, rose 120 points in just a couple of hours. The euro against the US dollar closed Monday's gap and tested 1.0850, and the dollar against the Japanese yen briefly traded below the 156, the figure mark. Now, the Fed meeting and statement saw some recovery for the dollar after the actual core data came out, and as we know, it was unchanged. And the median forecast by FOMC members suggests 1.5 cuts this year. So that's when we said just in the previous video, certainly 1, some analysts talking about 2 cuts this year. Let's just drill down a little bit further. Take a look at the Great British Pound against the US dollar. That fell short of the year high at 1.2895, and the price returned to that sort of multi-day flat corridor that we've seen of 1.2820 to 1.2700. Now moving forwards, If 1.28, the figure, fails to hold as support, we could well see a drop back down to the 1.27, the figure level. If we do happen to update highs and we continue to push on, we could well head up towards that 1.3000 level. We haven't seen that for some time, quite obviously. But again, data is going to be all important. And on Thursday of this week, we have the initial US jobless claims at 3:30. That's in the afternoon, GMT +3. That could well have an impact as the labour market in the US has quite a large part to play. We also have a speech by Janet Yellen of the FOMC. That's at 7 p.m. Thursday, GMT +3. And we've got the PPI figures to come out at 3:30, GMT +3. These could all well have quite a major impact on that pair and certainly may cause some volatility. Take a look at the US dollar against the Japanese yen. Well, that's trading near 157, the figure again. Take a look at the chart on a 4-hour time frame. That shows the formation of a bullish engulfing pattern, which may well lead to a test of 157.7 to 157.4 range. Now, unless the price falls below Wednesday's low of 155.7, if that happens, then obviously quite a different scenario. Certainly expecting some volatility early Friday morning because at 6 a.m, that's GMT +3 again, we've got the Bank of Japan's rate decision. As we know, they've already sort of dumped their negative rate holdings that they've had for quite some time. So that could be quite key as well on top of the data we're going to see Thursday from the US. So again, watch out for some volatility. Okay, so we've taken a look at the States and saw what's happened with sort of one of the main indexes and the dollar over there after data releases. Now we're going to take a look at the FTSE 100 or UK 100 as we quote it. And that declined on Tuesday after some news from the labour market. So we saw quite a sharp drop of nearly 1% on the UK 100 after this data release. The claimant count change, that's new claimants for unemployment benefit, was at 50,000. We expected that up 10.2,000 with a previous of 8.4. That's its highest level since March 2021 and was a little bit of a surprise. The unemployment rate also jumped up to 4.4% against the previous figure of 4.3%. On top of that, we also had GDP figures this week that have come in at zero, absolutely 0%. Wednesday did see some signs of recovery. And if we look at it from a fundamental perspective, GDP news was not actually an unpleasant surprise. Most expectation was around 0.1, so coming in at 0, not ideal, but not as bad as it could have been. Had we seen a negative figure, of course, it could have been very, very different. There's also the thoughts that a weakening employment market may well lead to the Bank of England cutting rates sooner rather than later, which, of course, should support the index itself. It's worth noting, though, that wage inflation is still remaining quite high, so there is a bit of a balancing act to be had there. If we take a look at the chart, well, that shows us at the low of the decline, support was found at the median line of that upward channel, which has been in place since last autumn, and that upward channel's in blue. The median line reinforced by the fact that it's a 50% Fibonacci retracement level from the bullish impulse A to B that we can see on the chart. So again, adding a little bit of extra layers of support there. The price failed to consolidate below the late May low of the circa 81.50 level. So the bulls might use this technical support factors to attempt to resume the upward trend within that blue channel, but it's going to need to break the resistance of the trend line that we can see in red, a shorter downward trend line. Again, data is going to be hugely influential in the coming days and weeks. So not a great start to the week for the FTSE, certainly not in the same lane, if you like, as over in the US. Okay, I'm going to finish off. We're going to take a look at gold and what's happened there over the last sort of week or so. And the gold price dropped after the US employment report came out late last week. Friday, we had the non-farm payrolls. That came in an actual of up 272,000 against an expectation of 182,000 and a previous figure of 165,000. Strong labour market may well equal continuation of tight monetary policy. Now, obviously, these figures came out in advance of that CPI data we've already mentioned. What happened off the back of these specific non-farm payroll figures? Well, dollar index went up and gold went down. In fact, there was more bad news for gold after it was revealed that China has stopped or is slowing down its buying of the metal for its reserves after an 18-month buying spree. ING were quoted as saying that China's appetite is slowing down quite significantly, buying just 60,000 ounces in April compared to 160,000 ounces in March. Now, if we take a look at the chart from Monday, I say the non-farm payrolls were last Friday, so the real activity comes from this chart on Monday morning. And it shows that it fell below the $2,300 per ounce mark for the first time since the 6th of May. Now, the price has been in the ascending channel, you can see marked in blue, since last autumn. However, since the high on May the 20th, the price does show a downward trend indicated by the red channel. And that red channel may well indicate a developing correction. Now, the bears lowered the price after the news Friday to the lower half of that ascending channel, and the target the bears may well be around the $2,200 per ounce, as this approximately aligns with the lower boundary of the blue channel you can see, and also corresponds to the 50% Fibonacci retracement level from the bullish impulse A to B. Now, if we take a look at what the bulls perhaps are looking for, well, potential resistance could be found at around the $23.23. That's $2,323. That's been support since last May until it was breached. And of course, we've got the median line of that blue channel. What's been happening the last couple of days? Well, it's recovered slightly, and at the time of recording, it's approximately around the $2,319 level, shy of that 2,323 level. So again, data has driven the markets the last week or so, and probably will continue to do so. So technical analysis, yeah, don't forget your fundamental analysis as well. And we wish you luck with your trading in the week ahead. Bye for now.